Good morning, and welcome to the weekly Monday morning market recap, brought to you by Island Park Private Wealth. We hope this message finds you well, and we want to begin by wishing you and your families a happy, healthy, and blessed 2026. As we start the new year, we'd also like to invite you to our first quarterly market webinar titled 10 Market Themes for the first quarter of 2026. The webinar will take place on Tuesday, January 13th at 7 p.m. Eastern Time, 6 p.m. Central. During this session, we'll walk through the 10 key market themes we are actively monitoring on your behalf, discuss how we are positioning the portfolios around those themes, and explain how we do so while maintaining a long-term perspective and never losing sight of your personal goals. Thank you, as always, for your continued trust and confidence in Island Park Private Wealth. And now, let's turn to this week's market recap. Markets started 2026 on a positive note, with major equity indexes extending their 2025 gains as leadership shifted to smaller companies and cyclical sectors. The bond market was quiet and produced modest gains as Treasury yields edged lower, and corporate bonds outperformed as credit spreads remained tight. The tone across financial markets was risk-on, but hedged, with Bitcoin and gold trading higher alongside equities. The economic data reinforced the picture of a two-speed economy, with divergent goods and services activity alongside softer labor conditions. The dominant market narrative centers on a soft landing, where the economy slows but avoids a recession, and the growth potential of the AI industry. Looking ahead, the main questions are whether stock market leadership will continue to broaden and how much further the Fed will cut interest rates. Our key takeaways. First, this week's economic data reinforced the divide between the goods and services sector. The ISM manufacturing survey remained below 50, signaling a 10th month of contraction and highlighting the sluggish manufacturing industry. In contrast, the ISM services survey rose from the prior month, indicating the services sector continues to expand. The data supports the view of a two-speed economy, with goods and manufacturing lagging, while services-driven growth remains strong. Point number 2. This week's labor data point to continued gradual softening. ADP's payroll report showed the U.S. added 41,000 jobs in December, up from a loss of 29,000 in November. Despite the rebound, the data represents a continuation of the slowdown in 2025, with job growth still well below levels we've seen in 2023 and 2024. Meanwhile, the number of job openings fell from 7.45 million to 7.15 million, among the lowest since early 2021. The labor market is gradually rebalancing with fewer openings, but continued job growth. Economists continue to categorize labor conditions as low hire, low fire. Point number 3. This week's stock market gains masked a rotation and shift in leadership. The S&P 500 and NASDAQ both gained around 1%, but their returns were overshadowed. Small cap stocks led the advance, with the Russell 2000 surging almost 5% and setting a new high. Leadership broadened across style exposures as large cap value and the equal weighted S&P 500 both gained more than 2.5%. In contrast, large cap growth finished the week flat as the technology sector finished with a modest gain. Market breadth improved alongside the rotation. The share of S&P 500 companies trading above their 50-day moving averages, a key measure of technical strength and participation, increased from 55 to 60%. Market gains over the past 2 years were driven by a narrow group of mega-cap stocks. This week's rotation signals improving breadth and balanced leadership entering 2026. Point 4. There was demand for hedges this week, even as stocks and bonds traded higher. Gold is up nearly 3% year to date and trading higher with equities, despite setting new highs to start the year. Similarly, the VIX, the Market Volatility Index, remains in the mid-teens but has drifted higher since the beginning of the year. So the market price action signals robust risk appetite, but the demand for hedges shows investors remain cautious. And lastly, geopolitical developments in Venezuela shaped oil and energy trading this week. Initially, oil traded higher early in the week, but reversed lower later as the talk of Venezuelan oil raised oversupply concerns. Inventory data added pressure on oil prices as gasoline inventories increased. Oil trades near 5-year lows despite elevated geopolitical risk, highlighting persistent oversupply concerns. Lower oil prices help ease inflation pressures and could continue to support consumer spending. So there you have it. It's our weekly Monday morning market recap and our key takeaways. Have a great week, and we'll talk to you next week.